Have you heard about the 4% rule as it pertains to your retirement? Well, in this video, we're going to share with you what the 4% rule is and how you can make some adjustments to ensure that you have enough money when you retire. My name is Carmen.
And I'm Darius. And the 4% rule basically applies to those of you looking to retire and not run out of money.
Hopefully that's everybody.
Yeah, that's everybody. So basically what the 4% rule suggests is if you have a portfolio of $1 million, then what it suggests is that you take out 4% each year. Now, you also have to take into account the inflation. So let's say you have the $1 million in your portfolio and you take out 4%, that equals $40,000 that you take out for that year. Now, let's say inflation was at 2%. Then following year, you're not going to just take out $40,000. You're going to take out $40,800 just to have the same amount of income.
All right, now let me interject real quick because I want you all to get this visual as you deplete your funds, right? So Darius said year one, we're starting with $1 million and you take out $40,000, right?
Now you have $960. You don't have $1 million anymore. You have $960.
Yeah. Now you take out $40,800 and now you have
about $920.
Exactly. So I want you to make sure that every time you recognize you're taking more money out of your nest egg, which is what we talk about all the time on the Wealth Nation channel. If you get a nest egg, you are depleting. So what we want to teach you to do is how to create cash flow so that you're not always depleting your accounts. Back to what you're saying, Darius. Sorry about that.
So basically what this doesn't take into consideration is the fact that we have a little more inflation than the 2%, and it doesn't take into consideration management fees. Let's say you still want to have your money invested so that you can continue to make money. But what happens if we have a market crash and you lose your money a lot faster? Now you're in a situation to where you don't know what to do. You don't have any money.
Yeah, we're knocking on doors trying to figure out how to make income.
Right. So now what we really have to take in consideration is not just a nest egg, but we have to really think about cash flow. We need a continuous flow of money. So we have to always be thinking about investments and how we can continue to make money versus building up this portfolio of money that's just a nest egg. So every time you tap into it, you have to take more money out because of inflation or taxes, depending on how you have your portfolio situated.
Now, the thing that I want you to take into consideration too is with the 4% rule that Darius was talking about, if you start with $1 million and taking into consideration the inflation that we're dealing with, you're not going to have 30 years of income. You're only going to have 15 to 16 years of income. So that changes things a lot when we think about this 4% rule. Back in the day, it might have made a lot of sense because our inflation rate was different. But now in today's world, it's a lot higher than what it used to be. And as of today, making this video, the 4% rule is going to essentially guarantee that you're not going to have enough money to last your entire retirement, right? So what we want to share with you is another alternative, something that is near and dear to our heart, and we call this a life insurance retirement plan, or a LIRP, and you may have heard this in the insurance industry. So what we want to do is flip to our screen so that we can actually show you what it would look like if you were to utilize a whole life insurance policy that is designed specifically for a retirement plan. So we're not talking about that this is a 401k or anything like that. We're just utilizing a whole life insurance policy to fund it now. And then we know that in the future, we're going to take loans from the policy so that we can use those loans as income. So let's go ahead and flip to our screen.
Now, in this example, what we're going to do is take a look at a 40-year-old male who is at a standard rating. And what he's doing is putting in $27,000 every single year in this 15-pay policy, which means he's going to pay it for 15 years. And then when it's time for him to retire, he's going to take a portion of that for his income. So it's $27,000 or $2,250 every single month. So if we look at the first column, that's what you'll see. You'll see the year of the policy, then you'll see his age. His age is 41 because when you do insurance, it's based off of your next prior year of age. So we're going to say this individual is 41 years. Then you see your net outlay, which is $27,000. In the second column, if you go down to year 15, you'll see that over the 15 years, he put in $405,000 into this 15-pay policy. The next column is the net cash value. This is how much money he has available to borrow at his discretion right now. Now, in the next column is the cash value increase, how much the policy grew within that year, followed by the death benefit. So at 15 years into this policy, he has $919,000 in death benefit, and he's put in $405,000. Now, let's say this 40-year-old male has done this for 15 years and he wants to retire at the age of 70. How much money does he have available to take for his income? If we look at the net cash value in the year 70, he has $964,019. And at this point, he also has $1.4 million in death benefit. So up to this point, again, he's put in $405,000, and for the next 20 years, he's going to take an income of $59,154. Now, at the end of these years, he's at this point has taken $1.2 million out of this policy. Now, remember, his amount of money that he put into this policy was $405,000, but he was able to take for income $1.2 million. And at this point, not only has he taken $1.2 million, the cash value at the end of the year 90 is $324,709, and his death benefit is $581,187. Now, the importance of this illustration is to show that he has predictable income for 20 years, ages 70 to 90, predictable income, and it's not tied to the market. And he's able to take out more money than he put in. So this is a good reflection of how you can have predictable income without taking on the risk of the market. This is additional income that he can have on top of whatever other investments that he's made. Say he's used this over his lifetime to finance his lifestyle. He has even more money available. This is just the policy itself. It's not taking into consideration the fact that he could have financed his lifestyle and had more money available than what's shown here. So what we want to do is give you an example of what you could do to add to your portfolio to help minimize the risk that you have from the market.
And the other thing too to note is one thing we didn't mention is how you can take $1.2 million of income inside this whole life insurance policy is because of the guaranteed rate of return in addition to the compound interest that is happening inside your whole life insurance policy. This is mind blowing for us because this wasn't something that was taught to us, nor was this offered as part of benefit packages, right? And so it just took us the time to understand different financial products, what's at our discretion, and how can we use them properly. So a lot of times on this channel, we talk about using a whole life insurance policy to finance your lifestyle. Did you know that you could use a whole life insurance policy to utilize it for retirement income? So we just wanted to share with you another option that you can use in addition to anything that's going on out there. But the whole point, again, is recognizing that you have a guaranteed rate of return, you have a death benefit that you can provide to your family, and you have flexibility to utilize this money without it being tied to the market. Because it is so important for us to recognize that the current retirement products that are out there are subjected to whatever's happening into the market and are subjected to taxes in one way, shape, or another. So we want to always give you the options to understand what else you can do. So this is called a life insurance retirement plan, or a LIRP. And if you want more information, you can click on the link below. We would love to serve you at the Wealth Nation.
Remember to own your own lifestyle,
or someone else will.